Thinking of using your SMSF to buy property overseas? It might sound like a dream investment, but there are serious hidden pitfalls that could jeopardize your entire fund. In this video, we uncover the ATO restrictions, the compliance risks, and the smart alternatives trustees are using instead. Let's dive in.
Have you ever had that dream? The one where your retirement fund owns a little piece of paradise somewhere? Maybe it's a sun-drenched villa in Tuscany or a slick modern condo looking out over the beaches in Bali. It's an amazing idea, right? And for self-managed super fund trustees, it can feel like the absolute ultimate investment move.
And let's be really clear here. This isn't just some fantasy. Investing your SMSF in property overseas is a legitimate strategy. And it's one that holds out this incredible promise of diversifying your portfolio, hedging against currency swings, and getting you a piece of high-growth international markets. It's a huge draw for anyone who's serious about maximizing their retirement savings.
So here's what we're going to do. We're going to take a journey together. We'll kick things off with that exciting dream, but then we're going to hit a pretty serious reality check. We'll dig into the hidden risks that can completely derail your plans, look at some smarter, safer alternatives for getting that global exposure, and then wrap up with the single most important element for success.
So, what's the big attraction? What's pulling everyone in? Well, it really boils down to three powerful ideas. First, it's about not putting all your retirement eggs in one basket, spreading your assets beyond just the Australian market. Second, it's a smart currency play. Holding assets in euros or US dollars can be a great shield if the Aussie dollar takes a dive. And third, it's about pure growth potential, giving you a front row seat to property markets overseas that are just taking off.
Okay, but here's where that beautiful dream collides with a very complex reality. The path to buying that overseas property with your super fund, it's not a straight line, not even close. It's more like a regulatory labyrinth with rules from both Australia and your target country that you absolutely have to get right. The first, and honestly the most important rule of them all, is Australia's sole purpose test. This is the absolute bedrock of our superannuation law. What it means is that every single investment decision your fund makes, doesn't matter if the asset is in Perth or Paris, it must be for the sole purpose of providing for your retirement. There are no exceptions, none.
And here's what that actually means in the real world. That Bali condo, you can't stay there. Your kids can't pop over and use it for a weekend getaway. It has to be a pure, hands-off investment that's generating rental income for your fund. Any personal use is a massive breach of the rules, and it comes with some really serious penalties.
So before you even start browsing properties online, you've got to get your own house in order. First things first, you have to check your fund's trust deed. It must specifically say that you're allowed to invest overseas. If it doesn't, you stop right there. Then, your formal investment strategy has to spell out exactly how this international property purchase fits in with your long-term retirement goals. These aren't just suggestions, okay? They're your first line of compliance.
All right, let's step into the landscape of hidden risks. And I'm not talking about minor details here. These are crucial, make-or-break hurdles that, if you ignore them, could seriously jeopardize the retirement savings you've worked so hard to build.
So back here on the Australian side, you've got this whole checklist of compliance hurdles. You've got to be super careful not to violate the 5% in-house asset rule, which can get really tricky with complex foreign ownership structures. You're also going to need annual property valuations that meet the ATO's very strict standards. Every single cent of rental income has to be declared, and those trips to inspect the property, they're going to be heavily scrutinized and probably won't be tax deductible.
And this is where the complexity just explodes. Many countries have their own set of rules. Some flat out restrict foreign ownership, which forces you into these really complex structures, like owning the property through a local corporation. And the problem with that? The structure you're required to use over there might directly conflict with Australian SMSF rules, creating a legal and compliance nightmare that could put your entire fund at risk.
And then of course there's the money. You could so easily fall into a double tax trap. Imagine your fund gets that nice 15% tax rate on rental income here in Australia. Great, but the foreign country might hit you with a 20% tax on that exact same income before it even leaves their borders. Then you add in local property taxes, stamp duties, and a huge capital gains tax when you sell. You can see how quickly your returns get eaten alive by paying tax in two different countries.
Beyond all the compliance stuff, the financial risks are huge. Currency fluctuations can literally wipe out your gains when you convert that money back to Aussie dollars. Transaction costs, things like stamp duties and legal fees, can be massive overseas. And this is a big one. Property is illiquid. That really matters because when you're getting close to retirement and you need to start drawing down cash, you can't just sell a bedroom. A slow, difficult sale process can seriously mess up your retirement income plans.
Okay, so it's complex, it's risky, and it demands constant expert attention. But what if? What if you could get all the benefits of international property, the diversification, the growth, without all the headaches we just talked about? Let's have a look at some smarter and, frankly, safer alternatives that, for a lot of trustees, are a much more strategic way to go.
This table really lays it out nicely. You got options like real estate investment trusts, or REITs. These are basically companies that own and operate income-producing real estate, and they're listed on stock exchanges, so you can buy and sell them just as easily as a share. Then you've got managed funds that pool your money to buy a whole diverse portfolio, and property syndicates that let you own a smaller piece of a much larger property. See the themes here? Professional management, lower cost to get in, and way, way less complexity.
But here's the thing. Whether you're thinking about going direct or choosing one of these alternatives, one rule is absolute. Thorough due diligence is non-negotiable. It is the single best way to protect yourself and your retirement fund from making a very, very expensive mistake.
So what does that actually look like? Well, it means doing deep research into the local economy and what kind of rental yields you can expect. It means getting professional building inspections and verifying the legal title. It means understanding every single local tax and fee, and it means being really aware of any political, regulatory, or even environmental risks that could sideswipe your investment down the road. And that brings us to the most critical takeaway from all of this. This is not a journey you should ever take alone. Assembling a team of qualified professionals isn't just a good idea, it is absolutely essential for success and for protecting your fund.
Your team should have a financial advisor to make sure this all fits your big picture strategy. You need a specialist SMSF accountant to handle the crazy complex compliance and tax reporting. You'll need legal experts who understand both Australian and foreign property law, and you definitely need a local property specialist who actually knows the market on the ground. Each of them plays a vital, non-negotiable role in protecting your investment.
So the crucial point is this. The goal isn't to run away from the complexity. It's to conquer it strategically. With the right knowledge from your own research and the right guidance from your professional team, you can make an informed and truly empowered decision about what's actually right for your retirement.
And that leaves us with one final question for you to really think about. After seeing this maze of regulations, the hidden risks, and the smarter alternatives that are out there, is that dream of direct ownership truly worth the risk for your retirement? The answer is going to be different for everyone, but now you can make that choice with your eyes wide open.